All right, well, as we await comments from Fed Chair Jerome Powell, let's bring back Joanne Feeney, Advisors Capital Management Partner and Portfolio Manager, and Sarah Howes, Wells Fargo Senior Economist. So, Sarah, obviously we're seeing increased market reaction here, but obviously we're still waiting for the exact wording to come from Fed Chair Jerome Powell. Just how tough is this balancing act going to be in terms of the wording of this?
Well, I think it's still going to be very tough because I think he's going to want to demonstrate that the committee is still very much committed to bringing inflation down, restoring inflation back towards its target, but also acknowledging the fact they've done a lot of tightening to date and it's time for things to slow, but they haven't given up on that inflation target. And so as some of the prior guests mentioned, I think it's going to be difficult to make sure that the market maybe doesn't run away with that somewhat more dovish message than the Fed has been signaling over the past few months, but balancing it with the fact that, yes, there's been a lot of tightening to date, but there's still a lot of work to do when it comes to inflation.
Joanne, perhaps Lloyd Blankfein, the former chairman at Goldman, tweeted it best. I imagine Jay Powell and the rest of Fed governors are right now sitting with the thesaurus, trying to find the right word that means pause or not pause, depending on who's listening. So what's the language you'll be listening for? What's the Fed drinking game, coffee, if you will? Is it data dependent?
Yeah, who knows what thesaurus they're using, but data dependent is a term I'm sure we will hear again. I think they will get into specifics to try to create that balance. One area is to be clear that house prices went up a lot, renters is up a lot. That's going to feed into keeping inflation on inflation. The labor market remains tight. They can cite the recent data on that. On the other hand, they're also likely to cite data that shows that the economy is slowing a bit, whether that comes from the liquidity constraints that we are starting to see pop up in corporate debt markets, government debt markets. We're seeing credit spreads widen. We're seeing bid-ask spreads widen. So there's clearly a liquidity constraint that should tamp down some of the economic growth that we've been seeing. They can cite that as the other side, that their policies are having an effect, but that they need to do more, that there's definitely more work to do given the pressure on wages, given the housing data. And so I think they'll have enough data in their arsenal to be able to strike that balance. I think they'll try to emphasize, that they are data dependent and that looking at inflation in the past, is only part of the data that they use, that they're doing a lot of observation of the economy in real time to gauge how much more work they have to do. And if, again, you look from an investing perspective, I think it's pretty clear there are fewer rate increases to come than we've had to date. And that does suggest a little bit of less of a headwind to stock valuations going forward from here. And I think that's partly what the market is reacting to.
And Sarah, in addition to the inflation data, obviously the CPI prints and the 5 prints that we're going to be getting out between now and the next meeting is going to be a big focus. What else, in addition to jobs, will you be focusing on over the next 4 weeks?
I think consumers.
Go ahead,
I think
Sarah.
consumer spending, in addition to just the labor market and inflation data. So we've seen weakness in business investment. We've seen weakness in residential investment. As RJ was talking about, we can't see the strength in exports go on forever, but how the household sector does, how willing it is to spend down the savings, lean on its balance sheets, I think will be pivotal for how long we can see the economy continue to expand and continue to put pressure on inflation.